Welcome to a BiggerPockets bonus episode. What's going on, everyone? This is David Greene, your host of the BiggerPockets podcast, here with a freebie for you. Today, Dave Meyer and I are going to get into a shorter segment on the state of the market. We're going to talk about what the Fed is doing and how that affects risk in markets, what's going on with interest rates right now, why they're rising, and if we can expect to see it, as well as some advice on what to do when you've got FOMO. There's a ton of options out there right now. We wanted to make a special episode because we recognize that, and we know a lot of you are wondering, what should I do? So Dave and I kind of get into some data as well as some practical sound advice for what to do when you feel like you have too many options and you're not sure where to go or what to do. You don't want to do nothing, but you don't want to make the wrong decision. If you're going through financial confusion right now, that's what we're here for. So sit back, put on your seatbelt, and take a quick listen to Dave and I breaking down the current state of the market and what you can do to win when you're in it. All right, so Dave, let's talk a little bit about interest rates and what has been going on since our last recording of the Bigger News podcast.
My favorite subject. Well, interest rates have gone up about 50 basis points, which is basically 0.5%. in just like 4 or 5 weeks. So they've gone from about 3.1% where they were around the beginning of the year, and they're now 3.5, 3.6%. And this is for the average 30-year fixed rate mortgage for a primary residence. And that is scaring some people. I'll wait to give my opinion, but what's going on is that people are nervous that this is going to cause a crash or a regression in housing prices, because there is in fact a relationship between interest rates and housing prices. But I'm curious what you think the relationship is and what this means for the housing market.
Well, there's two factors the way I see it. There's a practical component, meaning when interest rates go up, so does the cost of paying a mortgage. So the house becomes more expensive. And the more expensive a house gets, theoretically, the less the price of it should be, or maybe just the slower it can go up in price. There is some form of relationship. I think it tends to be exaggerated in the minds of people that aren't really familiar with real estate. They look at it like it's a very hey, if interest rates go up, prices go down. If interest rates go down, prices go up. It's not really that simple. I think it's, in practical terms, the psychological effect of interest rates going up and down do have a pretty big impact on the market. So I've seen a couple little hiccups. I believe we had one in maybe 2018, possibly 2019, where we had like a 3-4 month period where rates went up and everything froze. Like if you put your house on the market to sell it at that time, buyers were just not looking. They were all of the mind that, hey, we're just going to wait for rates to go back down. We don't like them going up. And then after maybe 2.5, 3 months, the majority of people said, oh, I guess they're not going anywhere. And they all came back on the market at the same time. I call it the flock of birds theory. If you ever watch a flock of birds, they tend to just move as one. Buyers in a market are often like that. When one person goes in a direction, the flock follows and they all kind of move as one big mass. So I see that, and I kind of play that as a real estate agent, the psychological impact of knowing everyone's going to move at one time. And so I think that has a role in what's happening. Like as rates are going up right now, it's going to cause fear. When people feel scared, they tend to not move. If you think about, like, Brandon Turner has this great analogy of driving in the fog. You don't drive fast. If you drive at all, it's very, very slow, because if you can't see where you're going or you feel afraid, you don't want to move. And I think that happens until people just accept that it's normal. What's your sort of take on it?
Well, I think in the grand scheme of things, it's really not that big a deal to me personally. I just ran an analysis because people have been asking me this question like crazy. And for a $400,000 house, having the rates move from 3.1 to 3.5 adds about $70 per month to your mortgage. So that's, significant for some people. For others, that's going to not really matter so much. So I think if it's going to affect anyone, it's going to really be on the fringe of people who are just trying to get into the market. People who are experienced investors who have a great salary, that's probably not going to impact them dramatically. I think the second thing is, if you are investing for the long term, which I think we would probably both recommend, you really have to sort of zoom out and take this all in context, because the media is portraying this as this crazy spike. And it is 50 basis points in 4 weeks is a lot. But getting a mortgage at 3.5% is one of the greatest things that you could ever wish for as a real estate investor. And so often we get into this mindset where we're like, oh, it was just so much lower. I missed out. But you have to look at what you're actually still getting, which I think if you were investing anytime prior to like 2015 or 2011, like you wouldn't even believe that people were getting 3.5% mortgage rates. Like investors from a different generation would be so jealous of this. And frankly, who knows what's going to happen? Interest rates have been on a negative trend for almost 40 years. And so I don't know if we're going back over 5% anytime. But I think that we're not going to go back to 3 or 3.1 anytime soon. But people need to still recognize historically that this is just an incredible opportunity still. And the other, so that's just my thought on rates and not buying too much into the recency bias of just seeing what's happened. The second thing is, which is crazy, is that the whole theory is that as rates go up, demand decreases, right? Because people don't want to pay more for mortgages. But if you look at the data over the last 4 weeks, demand has gone up. More people are applying for purchase application mortgages right now than they were before. And that is a little bit of this FOMO thing that's going on where people are like, oh, rates are going to keep going up and up and up. So I want to lock in now. So I don't know how long that lasts, but that's something I really want to pay attention to, because if you do see demand start to taper off, you'll see the housing market probably cool down. But in my opinion, cooling down the housing market is the best thing that could happen. I would love to see 5% appreciation rates this year instead of 12%. So everyone's seeing this terrible, but I actually think it's probably a good thing.
This is going to sound really weird, but as a real estate agent who tries to put buyers in contract in a hot market, the market cooling down would heat it up. As crazy as that sounds, I need it to cool down so that I can get one of my 15 buyers in contract that's getting beat out by the other 14 people that are in that deal. So I think that there's an argument to be made that rates going up could have slowed things down. But like you said, demand got even hotter, which means that it just got less hot than it would have maybe if rates would have went the other way, or it possibly could have, because like you said, there's the scarcity factor of, oh man, I better lock it in right now. I think that for the people listening to this that are thinking, I'm going to wait because if rates go up, prices are going to go down, and I'm not going to be the one left out there with my butt in the wind. If you're looking at how people make decisions about buying homes or buying crypto or anything, like oftentimes when you're buying stocks, you're buying a cryptocurrency, you are just trying to get ahead of what you think everybody else is going to do. You're playing a psychological game. It's very rarely based on fundamentals. Well, there's 3 components to processing information, and I got this out of the book, Pitch Anything. The first is what is called the croc brain. The croc brain's job is to look at anything and tell you this could kill you, and here's how, which is why our first response to anything new is always fear. So if I were to say, hey, Dave, do you want to invest in crypto? Your first thought would be, I don't want to lose my money. That's a normal, healthy thing. Hey, I'm raising money to buy this deal. I can get you a great interest rate. Your first thought is, well, am I going to lose my capital? That's what the croc brain does. If the croc brain believes that it's not necessarily going to die from whatever came its way, it allows it to move on to the next part of your brain, which is called the midbrain, aptly named. And the midbrain, its job is to take the information it's being given and compare it to all the other information that it's seen in a similar setting, like a social environment. So let's say that you heard a loud crash of glass. The first response everyone would have would be to jump. That's going to kill me. Something bad's happening. The midbrain would then say, no, we're sitting in a restaurant. This happens all the time. That's not dangerous. Now, if you're at home in bed alone and no one lives with you and you heard that same sound, your midbrain would say, you're in big trouble. It's time to do something. And then the last part of the brain is called the neocortex. And that's the part that uses logic and reason and rationale in order to make decisions. Now, this is important to know because most of us assume that we're only acting out of the neocortex. So most of the information that we're providing right now is neocortex type stuff. We're talking about what the Fed's doing and what rates are doing and the relationship between rates and home prices. It's all logical. But the midbrain is where most people end up making decisions. So it doesn't matter if rates go up if you don't have a better option to put your money in than real estate with a slightly higher rate. That's what it really comes down to. If you wanted to convince me that rates going up is going to change the market, you'd have to show me where people are going to put their money instead. Where is a better investment? If rates went up so high that real estate no longer made sense compared to other investment vehicles, I'd be completely on board. That's just the part that I want to highlight because it doesn't get talked about a lot. There's fear mongering that goes on where it's explained, oh, we have this going on and this is going to lead to a crash and everything's going to lead to a crash. But you got to show me where capital would be better put, because there's so much capital right now that needs a home.
Absolutely. That's a really good point. And I think if you look at the other asset classes, they are relatively, I mean, most of them, at least to me, are unattractive. You look at bonds, yields are still under 2%, which is way below inflation. So that's not really investing in my mind. That's just a slower bleeding of your cash. Then, yeah, right? Like who wants that? And then you have the stock and crypto market, which have upside, but are extremely volatile right now and likely due to the same thing, which is interest rates rising. And there are all sorts of reasons why that's happening. But basically, I think a lot of investors are seeing the first risk really to the crypto and stock markets in several years, and they're profit taking, which is what happens. You've seen this huge run up in asset prices, and for the first time, the Fed is signaling a policy change that endangers this bull run that has been going on for so long. And people are like, hey, I bought Bitcoin at 20 grand. It's at 60 grand. I'll sell a bit of that and just take some off the table, take a little bit of risk off the table. And personally, I think we're in for a lot of volatility over the next couple of years because, or at least a year or two in crypto, because there's this, like you said, it's a foggy economic picture. And to your point about rates rising, I do think people sort of over-index how important rates are. And they are important. They're extremely important. But the way you have to think about the housing market or the stock market, anything, is there's all these competing forces, right? And I always describe it, or economists generally just describe it as pressure, right? So certain forces, certain economic factors add pressure that pushes the market up, and certain market forces add pressure that push the market down. And the unique combination of those forces is what ultimately happens. And so we are now seeing that interest rates have switched, or are starting to switch. They haven't switched, but they've switched from this force that has been driving prices up. Now it's causing a little bit of concern, but it's not actively pushing prices down, because as we've talked about, in historical context, prices are still really low. But you have to think about the other forces that are pushing housing market prices up, which are extremely low supply, severely constrained inventory, and like you said, the general unattractiveness of other asset classes are all going, and demographics are all forces pushing prices up. So when you think about it, you can't just lock in on one of these metrics and be like, oh, rates are up, housing market's screwed. You have to think about all of these things in context, which is, I guess, why we're here talking about this.
And that's hard because it's scary. I heard Mark Cuban had a quote that Brandon quoted, because Brandon always wants to quote people and say it was his quote. He steals them all the time, like that. You miss 100% of the shots you don't take. Wayne Gretzky, Michael Scott, Brandon Turner, if he gives you credit. Well, he said business is like a sport. And in a sense, like, Mindy hates when we say that, because she doesn't like when we refer to money as a game, even though like it has things in common with the game. There's rules, there's strategy, there's things that you do that will lead to an outcome. But to me, it's like a sport in the sense that it's not computer code. It's not something that you have complete control over. There's influence that you can do. You have to make smart decisions, but you never know exactly how you could do everything right in a game, and at once out of every 100 games you might lose, even though you did what you're supposed to do. And then sometimes the other team fumbles and the ball goes right to you and you look like you're better than you were. That happens with money a lot of the time also. Like you said, when it comes to understanding what affects real estate prices, there are a lot of factors that go into it, and educating yourself will put yourself in a position to succeed, but it's not a guarantee. And if you play this game like, I'm just going to wait until it's a no possible lose situation and I'm only going to invest in that scenario, you're waiting for another 2010. Well, you better hope that you actually have money to invest when that happens, because capital becomes very difficult to invest. But it's likely that prices are going to rise so high that even if they get cut in half, they're going to be higher than they are today. I've seen that happen quite a lot of the time too. So there's a level of, like, I guess I would say you have to hold it with a loose hand. If you hold it really tight, I'm not going to make a mistake, or I'm not going to take action until everything looks perfect for me. You just watch that you don't make money in real estate. And here's the honest truth that people don't talk about. One of the honest truths. The most important ingredient in my mind for building wealth in real estate is time. If you take all the different pieces that make, a real estate cake grow in the oven, time is the most important one. And I don't think people should buy bad deals. I don't think they should buy just because everyone else is buying. I'm not saying flock of birds is you should go be one of the birds, but I am saying sitting out of the market, waiting for what appears like you just can't lose will lose you a lot of money because you lose time in the market. That's why we talk about buying properties that will cash flow even if they lose their value. All right, Dave, you mentioned that risk is coming back into the market. Do you mind unpacking that for us a little bit?
Sure. Yeah. I think that over the last 2 years, and we've been on this bull run in the stock market and the housing market for a decade now, and the last 2 years have sort of been unique. It sort of felt like pre-COVID, we were sort of reaching the end of an economic cycle, but then everything just got crazy, and the Fed has created extremely easy money policies. And this is basically stimulus to the economy in two forms. And the first is the one that we all know, which is that interest rates are extremely low. They have set their target rate near zero. And the second thing that you've probably heard that they're doing, which is they're buying assets. So they buy government bonds and they buy mortgage-backed securities, which are basically just bundles of mortgages. And what this does is basically puts training wheels on a lot of the economy. It makes it really, really hard for you to fall over as an investor. And not just individual investors, but businesses too. So when you look at these valuations of companies and what these corporate earnings, they are borrowing money lower than mortgage rates. They are borrowing money at 1 or 2 or 3% to expand. And now we're starting to see those training wheels get pulled off. And hopefully it's going to happen slowly so that you don't fall over and that there's time to adjust to it. But just the fact that the Fed has signaled that they are going to be removing that stimulus, that introduces new risk to the market because it means there's no one there holding you up as much. And the risk that is normally in the market, this is normal for us not to have training wheels, we're getting back to that. So I just think that's what we're seeing in the crypto market. We're seeing in the stock market, is that people are saying, there's been this time where I felt great. It was really going to be tough for the stock market to tumble until this happened. Now that this is happening, the reality is setting in. And it might be time for me to take some profit off the table and adjust into a more defensive position than I've been in the last couple of years.
And this is really important for our listeners to hear, mostly because we want them to be educated that what we've seen in the last year or 2 years isn't normal. So the problem is once you get used to something happening all the time, you just expect it's supposed to work that way. And you stop paying attention to what forces might be contributing to helping it work that way that we should just be grateful for that we don't deserve. And one of those is low interest rates for housing. So we know interest rates are low, but not everybody knows why. And you mentioned it's because the Fed buys mortgage-backed securities, which means that lenders can give away a lower rate and they can still sell that loan to someone because the Fed's buying more of them. They don't have to give as high of a rate to be able to sell the loan. Obviously, if you, Dave, are going to buy a note, the right to collect payments on a note from, let's say, me who originated it, you'd rather buy it at 5% than at 3%. That's going to be a lot more money for you over 30 years. So, but the consumer wants to pay 3%, not 5%. So what the government did is they stepped in. They said, well, we'll buy all these notes at the 3% so that banks can give them away at cheaper rates. And that will make it easier to borrow, which makes it easier to buy, which makes it properties worth more, which means that if you already own a property, you're more likely to sell it. If you sell it, maybe you go buy two. And then all of these people that work in the real estate industry, the title officers, the home inspectors, the appraisers, the loan officers, the underwriters, the processors, the handymen, everybody is now making money because of the velocity of these transactions, which means that they're now paying more income taxes and the whole economy gets spurred. But it's not spurred by natural causes. That's what we're pointing out. There were artificial things that were being done to create that. So you shouldn't expect it to always be that way. And that's what you're talking about, at least what I'm understanding here when you're referring to risk coming back into the market. It's really like naturalism coming back. Like the Fed normally shouldn't be buying mortgage-backed securities. The free market should decide what interest rates are going to be and investors deciding how much they're going to borrow. So those of us that do invest in real estate, we pay attention to all this stuff because it affects the end result of what we're getting. But we do need to be aware that it's not always going to be the way that it's been.
Yeah, I agree. And I think one of the things I'm going to be watching is what happens with interest rates now, because it seems that the mortgage market is pricing in about 4 rate hikes from the Fed in 2022. And that is going to raise mortgage rates. I mean, that is just going to happen. But we've also, I think I mentioned it earlier, seen that interest rates have been on a decline since 1981 on a trend. You know, it goes up and it goes down, but you know, we were at a point where we had double-digit interest rates, and ever since then, it has just been slowly and steadily declining. And you see that not just in Fed policy, but also in U.S. Treasury yields, which is one of the best predictors of mortgage rates. And so, are we ever going to get to a point where there are mortgages considerably over 5%? To me, that is a really big question. And back in the day, you would say, yes, of course. But we haven't seen that in over a decade, even during periods when there wasn't quantitative easing and when there was higher Fed interest rates. So it's really unclear what's going to happen in the long term. But for me, for right now, I like to just remember that it's pretty much never going to go past, you know, it's not going to go much lower than it has been at 3.1%. And so again, historically at 3.5%, I think it's there's risk in the short term, but grabbing something at 3.5% is really solid decision in the long term.
You made another really good point about the minute we saw crypto drop, how many people got out of it. That leads me to believe that a big chunk of crypto investors are not buy and hold investors like real estate. They don't necessarily believe in the asset. And if you are, please don't be offended. I'm not saying that it's not a good asset. I'm just saying a big chunk of people that invest in it don't see it that way. Because when they saw the dip, they immediately got out. They were, like you said, that was probably a safe haven for a lot of people to put their money in until they figured out what was going to happen. They were able to get a pretty easy, fast return. But when it looked like it wasn't safe, they yanked it right out. There's a lot of that's going on in the market as well. Things that we've been watching go up and up and up. And you've been asking yourself, should I be buying NFTs? Should I be investing in the metaverse? All these people are making money. But as you see, as soon as the psychology shifts a little bit, it comes right out. And the other thing I'll add is you only hear about the people that are making money in NFTs. You don't hear about the people that are losing money in NFTs. No one goes out there and says, I spent $300 and it's worth nothing now. So like try to avoid that fear of missing out that comes from marketers that are waving this thing in front of you. I see you smiling, Dave. Have you noticed that too?
Dude, I can't understand NFTs. Like I get the technology and I get what they are. People are like, you don't understand what I get what they are. It is just such wild speculation that I think in one of the other shows we talked about like the Dutch tulip mania, and I live in the Netherlands, so it's prevalent for me. But it is just so wild to me that people are just speculating like this. And I invest in cryptocurrency. I think there could be inherent value in cryptocurrency, and I'm not selling mine. But NFTs right now is like the last place on earth I personally would want to be, which probably means it's going to go up like 10,000%. And I'm going to eat my words in like 5 years. But like logically, I just can't get my brain around it.
Well, I would say, so one of the books that I base my entire wealth building like model off of or principles is The Richest Man in Babylon. I love the book. And one of the principles in that is don't invest in anything you don't understand. And that has kept me safe in so many areas because I feel the temptation just like everyone else does. When you hear about others doing something, hey, there's gold in them thar hills. We're going out to California and we're going to go get it. That you think maybe I should go too. I heard about all these. It's natural to have that. What has kept me anchored was I made a commitment to not invest in anything that I don't understand. And so if you're an NFT expert and you follow that world and you pay attention, that person, I would not say, hey, you should not be investing in NFTs. It makes sense for them. For those of us that are listening to BiggerPockets and like real estate, we just hear about this happening. No. That you're not educated in that space. Don't get into it hoping that you make money. That is what we call speculation, which means you are giving up control of your outcome. Stick to real estate, which is typically more boring, slower, not sexy, and that's why it's awesome. It's like watching grass grow. You just want to let that grass grow. And so as we kind of navigate all of the changes, if you think about, we've got massive inflation. We've got the information age where it used to be, in order to make money in a certain asset, you probably had to have a mentor that you learned under for a couple of years to even have an idea how to do. I mean, at one point, you needed a human being that could help you trade a stock, and they had to be licensed in being able to do that. It wasn't like an app on your phone you could push a button. Then you've got technology increasing to make everything easier that we're already doing. And then you've got like creativity springing up where people are literally making things up out of thin air to make money with, like NFTs, right? All of that is intersecting at one time. And it's normal that you might feel overwhelmed and overloaded with all these opportunities, as well as if you're here, you're probably an ambitious person that wants to create more wealth. So just recognize you're in a challenging environment. That's why we're putting out shows like this. We're making more content, because I want to encourage you to hold the line. Save your money, do a good job, put it into smart investments, and take the long-term approach.
Totally. I think about this. I was just skiing. I love skiing. And I just think, like, right now is like, it's a tough market. It's like it's a black diamond market right now. We're not like in this area where we're, recklessly skiing off the edge, but it's hard. You need to have skill right now. You can't just put money into anything and hope it's going to go up. And we've had that for a couple years, and that's changing. And that doesn't mean that you can't navigate your way down the hill. It just means you got to pay attention and stick to what you know and not be reckless. I think, I was on another podcast recently, and I was just talking about, I'm sure you've talked about this a million times, the concept of a buy box. And I think I keep coming back to that idea. It's like, it's so tempting in a market like this to be like, oh, rates are going up, I could have gotten a better deal yesterday. Or what's going to happen next year? Is it going to be a crappy market? Maybe. But at the end of the day, if a deal works for you right now, that's really logically all you should be thinking about. There's nothing else you can control. And so your option is either to get frozen in place or to be diligent, figure out what deals are good for you and for your lifestyle and your goals, and stick to that. That's really, it sounds so simple, but that's all you can do in a market like this.
That is exactly right. And if you can't find anything that fits in your buy box, don't think that means that it's helpless and do nothing. Keep saving your money. Keep educating yourself. Keep improving your skill set. Keep meeting other people that at some point could help you, because you never know when that opportunity is going to come along, and you don't want to be saying, I wish that I'd spent the last 6 months preparing for this, instead of, what do? I'm frantically looking up how to estimate rehab costs because I didn't pay attention to it until I actually got the house under contract.
Yeah, that's very sage advice. I think that being prepared is probably the best thing you could do right now, because as things change, you need to be agile and be able to adapt to the situation. So as David said, that is why we're here, and we're going to keep putting out information like this. And, listen, this stuff changes. David and I are doing our best to read the room, read the environment as best as we can. But like we said at the top of the show, interest rates changed faster than I was expecting, at least. And so as we adjust our own opinions and as things change, we're going to make sure to keep putting out these types of shows to make sure that you guys are on top of everything that's happening. We'll weigh in where we can. But ultimately, hope that you all are doing your own research and staying on top of this stuff as well.
If anybody has any questions with me about what I'm investing in, please send me a message on social media. Dave, where's the best place people can get a hold of you?
On Instagram, of course, where I am at The Data Deli.
And I am at David Greene 24. Send us a DM about any questions you had about this show, and leave us a comment in the YouTube section to let us know what you thought about this and what else you'd like us to talk about. And we will make sure to give you what you'd like. This is David Greene for Dave the Data Deli Meyer, signing off.